Hey everyone, and welcome. Today, we're going to dig into something that affects a ton of investors. We're talking about those big, popular market funds. You know, the ones you buy thinking you're safely spread out across hundreds of companies. But what if that diversification you're counting on is, well, kind of an illusion? Okay, let's get into it.
So let's just start with a direct question. Think about that S&P 500 fund in your portfolio. Yeah, the one with 500 of America's biggest companies. You probably bought it for that nice, safe feeling of diversification, right? But is it actually doing the job you think it is?
Check this out, 40%. That's roughly how much of the S&P 500 is made up of just 10 companies. Seriously, let that sink in for a second. Only 10 companies are driving almost half the performance and the risk of an index that's supposed to represent 500. This is a whole new ballgame.
And that brings us to our first big topic, this new market reality. We're seeing a level of concentration that is truly unprecedented. It's a historic high, and it completely changes the game for investors. So let's break down exactly who's holding all the cards.
You know, probably the easiest way to picture this is with a pizza. Imagine your S&P 500 fund is a giant pizza cut into 500 slices. Now, if it were truly diversified, every slice would be about the same size. But that's not what's happening. Instead, just 10 of those slices are so enormous they take up nearly half the entire pizza box. And the other 490? They're just kind of squeezed in around the edges.
And here they are, those 10 giant slices. The names aren't a surprise to anyone, right? NVIDIA, Microsoft, Apple. But what is staggering is their individual weight. I mean, NVIDIA and Microsoft together are more than 14% of the entire index. It's wild. You add them all up, and there's that stunning 40% figure. Your diversified fund is actually making a massive bet on these few mega companies.
All right, so if you thought the S&P 500 was top-heavy, just wait. Things get even more extreme when we look at its tech-focused cousin, the Nasdaq 100. So let's compare the two big ETFs here, SPY for the S&P and QQQ for the Nasdaq.
And here's the deal with the Nasdaq 100. The concentration is on another level. The QQQ isn't just leaning on its top players, it's practically being carried by them. We're talking more than half the fund's entire value resting on just 10 names.
And you can really see it here. I mean, look at this chart. That huge slice, that's just 10 stocks, but it makes up a whopping 51.7% of the whole fund. The other 90 companies, they're all crammed into that smaller piece. So when you buy QQQ, what you're really buying is a concentrated bet on big tech, with a little bit of everything else sprinkled on top.
So putting them side by side really makes the difference pop. SPY has 500 stocks, top 10 weight is around 40%. QQQ has just 100 stocks, and its top 10 are over 52%. So you see, SPY is meant to be your broad U.S. market fund, while QQQ is an aggressive, no-apologies bet on tech and growth. Neither's good or bad, they're just fundamentally different animals.
Okay, so this all leads us to the million-dollar question. Is this concentration a good thing or a bad thing? And the real answer is, it's complicated. It's a massive trade-off between the potential for huge growth and some pretty serious concentrated risk. Let's break that down.
This quote from our source material just nails it. The fate of your fund is now completely tied to how a handful of these corporate giants perform. If they soar, you soar right along with them. But if they stumble, well, there's really nowhere to hide. Your returns and your risks are both amplified.
Think of it like a coin, right? On one side, the upside, you've got this incredible growth. I mean, these mega caps have been the engine of the market. The data shows the more concentrated QQQ has actually crushed SPY over the last 3, 5, and 10 years. But then you flip the coin. The downside is that performance comes with a ton of risk. You're super exposed to tech, and if just one of these giants stumbles, your whole portfolio feels it.
And hey, this isn't just a feeling. We can actually measure this risk. The QQQ is estimated to be about 15 to 20% more volatile than the SPY. So what does that mean in plain English? The swings up and down are just bigger. It's a much bumpier ride, and that's the price of admission for that potential for higher growth. So all of this really forces us to rethink what diversification even means. It's clearly not just about how many stocks you own. Sure, SPY holds 500 stocks, but its effective diversification is way lower because of this concentration. For comparison, if you want that truly broad exposure, a fund like VTI, which tracks the entire U.S. market, has a top 10 concentration of around 31%. That's much less reliant on just a few big names.
All right, let's bring all this home. Knowing what we know now, how do you decide if a concentrated strategy like this, whether you chose it on purpose or just kind of fell into it, is a good fit for you?
Now, this isn't about giving advice. It's about helping you understand the kind of investor this might work for.
This kind of concentrated approach really boils down to three things. First, you need conviction. You have to genuinely believe that these tech giants will keep dominating. Second, your time horizon. You have to be in it for the long haul, with years, even decades, to ride out the bumps. And third, your risk tolerance. You have to be okay with those bigger swings we just talked about.
So to sum it up, this kind of strategy can be a great fit for growth-focused investors who can handle the risk and have a lot of time. But on the other hand, it's probably not the right fit for someone who's nearing retirement, needs their portfolio to be stable, or someone who truly wants to be spread out across many different parts of the economy.
And of course, it is super important that we're clear about this. This is just an analysis to get you thinking. It is absolutely not investment advice. The whole point here is to give you the information you need to look at your own investments and see if they still line up with your personal goals and your comfort with risk.
So we'll leave you with this one last thought to chew on. Now that you understand the hidden concentration in your funds, you have to ask yourself a tough question. Is your portfolio strapped to a powerful rocket ship that's ready for takeoff? Or is it balanced on a knife's edge, where one wrong move from a handful of companies could send the whole thing tumbling down? The answer to that changes everything.